In a disappointing first quarter performance, and naturally the market's response was harsh. The Infosys stock dropped over 10%, the largest percentage-wise intraday fall in nearly 28 years. But this harsh response has not just been about Infosys' revenue growth being below par. It stems from the fact that the company has lowered its FY17 revenue growth guidance. CNBC TV 18's Rukmini and Kritika Saxena have the details.
I am disappointed with the revenue performance that we had in Q1.
That pretty much sums it all up. In what is without a doubt a sluggish start to the financial year, Infosys recorded just a 2.2% rise in dollar revenues instead of the widely expected 4.5%. It's not just analysts who received an unpleasant surprise, though.
I had expected that we'll do better, and this happened because of some unanticipated slowdown in some discretionary parts of consulting and package implementations, and also some of the large deals that we had won in the quarters before were slower to ramp up their projects.
But Sikka's disappointment does not encompass every performance parameter, though. Net profits fell a lower than expected 4.5%, and there's some relief that margin contraction caused by wage hikes and increased visa costs stopped at 140 basis points. However, while the markets may have forgiven weak revenue growth, they could not forgive Infosys for cutting its constant currency revenue growth guidance for FY17 to 10.5 to 12% from 11.5 to 13.5%, a clear indication that the problems of the first quarter will not disappear anytime soon. Margin pressures are also not expected to ease up in the near future. Infosys has changed its margin forecast slightly from the earlier 24 to 26%. It says it expects short-term margins to come in between 24 and 25%, but adds medium-term forecasts remain unchanged.
Margin is a derivative of two things. One, of course, the cost optimization piece, which we'll continue to do and which are progressing well. As a revenue trajectory for the balance 3 quarters, we need to watch. If the revenue trajectory, keeping in view whatever we have given the revenue trajectory, at this point in time we are looking at comfortable with 24 to 25% margin, and last year we ended at 25%. That's what we are seeing.
Another positive is that the momentum in large deal wins has continued, with the first quarter seeing contracts worth $800 million being signed. But ask analysts and they point to more pressing concerns, including a 2.2% volume growth has been the slowest in 5 quarters and the slowest first quarter growth since FY11. A sluggish 1.7% constant currency growth in the financial services vertical points to clients ramping down budgets, and a 0.7% slip in pricing on a sequential basis. What makes matters worse is that this disappointing quarter comes after a steady 4-quarter run, a streak that had experts believing the turnaround was here to stay. Now, experts say that Indian IT may be in for some tough times as clients cut spending, pricing pressure mounts, and the ramifications of the Brexit becomes better defined. With Rukmini in Bengaluru, in Mumbai, Kritika Saxena.